So what is a 401k retirement plan? Is it really the best thing that you want to be using? Is it something you're offering through work right now, but is it the thing you should be putting all your money into to create real financial freedom in the future? I found out something that might surprise you, so be sure to watch this video because I'm going to talk to you not just about the 401k, but maybe something that's going to be better for you than just using a 401k. All right, so let's just start by defining what is a 401k plan. Now, if you ever see the numbers in the letter 401k, it's a tax code. That's all it really is. It's not really an investment, it's a tax code. So think of it like a little shelter, right? It's like a little box, that you put around the investment. And it's tax code 401 subsection K. That's what it really is. Simply put, it's a retirement plan that you're offered usually through your employers. You can even set up a solo 401k if you're self-employed. You do things like that, of course. But you can, and actually even if you're not self-employed, you can actually set up different types of plans similar to a 401k. But 401ks are typically retirement plans that are set up with government protections. Now, the good news about a 401k is that you do have protection. It's one of the few places you can actually store your money where it is protected from lawsuits and creditors. That's the good news. The other thing is that you usually put in with pre-taxed dollars. So if you work for a company that offers a 401k plan right now, what they're going to tell you is they'll take the money out of your paycheck before it gets taxed. So it hasn't been taxed yet when they take the money out. They put in this 401k plan. This 401k plan usually is in some sort of investments. Most people, it's some kind of mutual fund investments. Although, if you have a self-directed 401k, you can actually go into other things that we'll talk about in a minute here. But usually it's just whatever standard mutual funds they got available with that company. So if it's Fidelity that you have the 401k through, okay, cool. Well, then Fidelity will say, here's your suite of things to pick from. You put your money there. They take that before tax money, put it in there, and then it either grows or declines depending on what the stock market or the investments are doing in there. Now, the money in there grows tax-free and then comes out taxed, right? Because you didn't get taxed on it. So it grows without any taxes on it while it grows. But when you do pull the money out, you will be taxed at the highest potential tax rate, which is the income tax rate, the ordinary income tax. So because you didn't get taxed up front, they are going to tax you in the end. And you usually have to wait till you're at least 59.5 to get taxed on that money. So the good news is it grows tax deferred. Bad news is you still got to get taxed on the back end, right? So if you get a 401k plan, just know that you will be paying taxes someday. Now this is the real debate, right? Is the 401k better or worse? Do you want to be taxed up front, like a Roth IRA does, or would you rather wait to be taxed on the back end when it's grown to whatever amount? If you're taxed on the back end, the question you have to ask yourself is, are taxes going up or down in the future? I know this is an interesting debate and nobody really knows the truth of this, and it depends on how far in the future it is for you. But I'll tell you this, most people, and when I ask that question, will taxes go up or down in the future? Every time, especially because they know that this is one of the lowest tax rates we've had in history in the last 110 years, most of the time they'll say up. So here's the question that I had asked myself when I was in my 20s looking at a 401k plan for the first time. I said, wait a minute, if they're going up, do I really want to put my money in a place where I'm going to get taxed more in the future? Or is there a way I can get taxed now and then not get taxed at all in the future? Now, there might be an option you have through your work called a Roth 401k. Now, if you have a Roth option, this could be a good option for you, right? Because that money does grow tax deferred and it comes out tax free in the end. Now, you do get used after tax dollars. When it comes out of your paycheck, instead of the pre-tax part, like some of the expenses come out on your paycheck, it comes out post-tax. Now, just because it comes out post-tax doesn't mean it's a bad thing. It just means that money's going in, you're able to pull that money out, right? And when you pull it out, it is tax-free, at least the way the current rules are. And this is the risk you run with any qualified plan. And I say qualified plans, I mean 401ks, IRAs, 403bs, 457s, all these kind of plans. Anything that's basically a tax code is government controlled. Your silent partner is actually the US government. And many people I've had a few people here, I'll try to argue with me on this, but if you look it up on your actual paperwork, if you look up, you can go Google it if you want, right? If you look up about 401ks, you'll find out that you're just the benefactor of the 401k. The US government is the controlling partner. So if they change the rules at any time, so like right now, for example, you're not supposed to pull out your money before you're 59.5 years old. Why do they say half? I don't know. It's weird. It doesn't like to do anything simply, apparently. So 59.5 is the age that if you pull out your money before you're 59.5 years old from a 401k, you will not only be taxed that money, but you'll have an additional 10% penalty on top. So many people will say, oh, I don't want to do that, so let's keep it in there till I'm at least in my 60s, right? Which is why most people will retire in their 60s. But the problem is this, is that there's also minimum withdrawals that you have to do at age 72. So if you don't take out enough at age 72, they'll actually penalize you 50% of the money you should have been pulling out that year. So even if you don't pull money out, guess what? They'll force you to take money out because they want their taxes now. Now, if it's in a Roth, you don't have that rule on the 72 age. Now, you do have the 59.5 rule with the Roth 401k, so at least you have that, tax-free coming later, and you don't have to worry about the 72 rule and all that kind of stuff too. But the issue is this, is that it always comes down to what's the best fit for your plan, what you're trying to do. If you want to retire before 59.5, maybe the 401k isn't the best option for you. Maybe you want to do something different. And even the Roth IRA or the Roth 401ks, maybe those aren't great options either. So what else could you be doing? Well, one option you could be doing, instead of doing the 401k, and this is what a lot of our clients will end up doing later. And by the way, the one benefit of a 401k is that you get the match from the employer, right? They put the match on top. Just so you know, this is not a 100% rate of return. It does not work out that way. It ends up maybe adding long-term 2 or 3% a year. And by the way, most 401ks don't perform that well. So you're lucky to even get market returns, even though you have a 401k with a full-on match. I have other videos on that topic in other videos here on this Money Ripples channel. There's a whole myth of the match you should look up for sure. The other option I do, and a lot of our clients will end up doing instead of the 401k, is they'll actually do what we refer to as max ROI infinite banking. This is different than traditional infinite banking. Traditional infinite banking is, in my opinion, too expensive. It actually takes more money out of your pocket, doesn't really give much back, and is really not worth it. But our max ROI infinite banking is where we use a whole life insurance policy. This is different than just death insurance, like your term insurance that you might get through work or that you can get on your own. Whole life insurance is actually an asset, not an expense. It does have insurance costs coming out, especially because they take them out in the beginning, those first few years. But after the third year or so, this money that you have in there is actually paying for your insurance costs and growing by more than what you're paying into it. So the plan actually starts to really grow. Usually for us, by the 5th or 6th year, you have more than what you paid into it already, despite those life insurance costs coming out of it. What's even better though is the cash that's in there grows just like the Roth IRA, is taxed just like the Roth IRA, meaning you put in with after-tax dollars, grows tax-free, and you can access that money, pull it out tax-free, and there's no 59.5 rule. So even just that alone could be a potential retirement income. But then I would get people to ask me the question. I said, well, Chris, but I've heard you say that you've actually been able to retire before you were 40 years old. You retired twice by the time you were 39. Just so you know, I retired twice because I screwed up the first time after I was 28. The whole economy, the Great Recession affected me. So I ended up going back in the rat race, had to do it again. And I was able to retire the second time when I was 39 back in 2016. And so the way I did that wasn't just using whole life. It wasn't using 401ks. It wasn't using any of those traditional retirement plans. Instead, I was investing in real estate. And I wasn't doing real estate where I was actively managing it and doing all the work, the hard work. I wasn't like going and hammering stuff, because trust me, I can barely build a cabinet from IKEA. And even then, half the time I put the stuff on backwards, I have to disassemble it and reassemble again. I don't know if you're like that. Maybe it's just me. But I'm not the most handsy guy, right? I better say that differently. Handsy doesn't sound right, does it? So I'm not the best hands-on, kind of blue-collar kind of guy. I'm very, very white-collar, obviously. I'm teaching about money. So I'm just not great in using my hands. But I am really good at making my money work harder for me. And so instead of actually doing that, I invest in other real estate people that do the work for me. So yes, I could get a rental, but I don't property manage that property. I have a property manager doing the work for me. They find the renters. They deal with all that stuff. They deal with the tenants, the toilets, and the trash. I just collect the checks. Yes, I can lend my money to real estate investors. I could lend the money to them like I'm the bank and make 10, 11, 12% a year on that money, or more even. I can actually go and invest in big projects with other investors. We pool our money together, what's called a syndication. And guess what? I can invest in things like apartments, self-storage, franchises like car wash businesses, or whatever it might be. I can put my money into all these kind of things. I can go put my money into oil and gas, like get royalty payments and things like that, and even get some tax advantages. I can put my money in and do things like partnerships. I have a raw land partnership that I use right now. I can invest in all kinds of things where it's not just locked in this tiny little cubby of mutual funds that they say I have to invest in, and that's all I have to do. I can be free to invest wherever I want. Not to mention, of course, if you have a business, if you're a business owner, oh my goodness, having a 401k plan is worse because you don't even get the match. You have to pay your own match, which really is no benefit at all because you still have to get taxed on that. You're like, yay, I paid the match. I got the write off of my company. Oh yeah, but you get to pay it down the road anyways. And who's to say you're not gonna be taxed more than you would if you just did it today with all your write-offs in your business. So even have a 401k through your own business is just ridiculous. If you're an employee, it makes a little bit more sense. But even then, they still got those rigid rules that can change at any moment, and you just have to go with it. No matter what, you really don't have a lot of control. Personally, I love control of my money. I like to know that I have that money that I can take and use it to invest in other things. Now, yes, you can do variations like solo 401ks, of course. Those are variations you can actually do, especially with business owners, or if you have a LLC or a business on the side as well. There could be cool, creative ways to make money with that. But again, I don't always trust the government. I like to put my money in places like with the life insurance, the whole life insurance, that max ROI, infinite banking. I do things with that because I know that if they change the rules, I'm contracted in at the time that I created it versus wondering what the government's going to do down the road. So I get to keep those tax advantages right in my control, my possession. And technically, I can actually use that money to invest in real estate as well and make money in two places at the same time. And that's a whole nother video just on that kind of concept, which we have on moneyripples.com anyways. All right, so if you're looking at 401k plan, great. It could be a good option for you. And it may or may not be the best option. However, if you're wondering, how can I actually create more passive income now versus waiting into my 60s to access my money and then maybe creating passive income? So if you want to learn how to actually do that for yourself, go ahead and click on the description below. We'll take you to a link to show you how you can actually create that in your own life right now. So check that out today.